When a bank reviews your business, they ask one question first. If something goes wrong, who absorbs the loss? Not the paperwork, not the idea, the loss. In the next 20 minutes, we're going to explore how banks actually evaluate your business structure. Now, imagine applying for a business loan tomorrow. You walk into the bank confident. You form the LLC. Paperwork is organized. The business has revenue. So, you assume the bank is going to review your projections and decide whether the opportunity looks promising enough to secure funding. But that's not the first question that the bank asks. The first question is much simpler. If something goes wrong, who absorbs the loss? Because banks don't evaluate businesses the way founders do. And in this episode, we're going to walk through how banks actually answer that question. Not the theory founders talk about, the process banks use when they review a business. We'll look at the documents they examine, the financial patterns they study, and the signals that lead a bank to conclude whether a business stands on its own or whether the owner is still carrying all the risk. Entrepreneurs evaluate opportunity. Banks evaluate risk. And the first risk that banks examine is structural. The first thing a bank reviews is not your projections, it's your formation and ownership documents, articles of organization, operating agreements, ownership disclosures. The bank studies these documents in order to answer a simple question. Who actually controls the company? If every decision authority points to one person, the bank immediately recognizes that the business may still depend entirely on the owner. When a bank reviews a business, it's trying to answer three basic questions. Can the business operate independently? Can the business absorb financial pressure? And if the business fails, who ultimately carries the loss? The bank can't rely on the owner's belief or intention. It has to rely on evidence. So they start collecting information. The first information the bank reviews is structural. Articles of organization or incorporation, operating agreements or bylaws, ownership disclosures, EIN documentation. At first glance, it looks like they're just going down a simple checklist. But they're not just confirming that the documents exist. They're studying the documents to see where authority lies. Who owns the business? Who controls the business? Who can bind the business to obligations? If a single individual owns and controls everything, the bank immediately understands something important. The business may exist legally, but operational authority is concentrated in one person. And that signals dependency. Not necessarily failure, but dependency. At this point, you may want to pause and think about your own business for a moment. If a bank reviewed your company tomorrow, what would they actually see? Not what you intended, and not what the paperwork says. What patterns would appear in the documents and financial activity? Next, the bank studies financial statements, tax returns, profit and loss statements, balance sheets, business bank statements. Again, the bank isn't just looking at revenue, it's studying patterns. Does the business generate stable cash flow? Does the business maintain reserves? Or does the owner regularly inject personal money to keep things stable? Those are the patterns that tell the bank whether the business survives independently or whether the owner repeatedly acts as a superhero. If the owner consistently rescues the business financially, the bank looks at the structure sideways. The entity exists, but the business appears financially dependent. Think about a house. A house may look strong from the outside: walls, roof, windows. But engineers don't judge the house by the walls. They examine the foundation. The foundation determines whether the house survives pressure. If the foundation is weak, the house may appear fine until a stress event occurs. Banks evaluate businesses the same way. The entity is just the visible structure. Financial behavior reveals the foundation. If the business already banks with the institution, the bank sees something even more revealing. That's like the backstage view. Cash flow patterns, deposits, transfers, payments. From here, the bank can see whether the business consistently operates on its own revenue or whether the owner regularly injects cash. Frequent owner transfers are a telltale sign of financial dependency, and irregular deposits signal instability. Consistent operating revenue signals independence. These patterns form the behavioral profile of the business. The bank also evaluates credit history, both business credit and personal credit. If the business has little credit history of its own, the bank makes the assumption that the owner's credit has historically supported the company. Again, this doesn't invalidate the entity, but it does signal that the business hasn't yet proven independence, which means the bank is going to protect itself. At this point, many founders recognize something surprising. Banks aren't evaluating the business the way entrepreneurs evaluate the business. Entrepreneurs ask whether the business works. Banks ask whether the business stands on its own. Those are very different questions. A business can operate successfully for years while still appearing structurally dependent. Once the bank forms an opinion about structural independence, it reacts by adjusting the loan terms. If the bank believes the business stands independently, the terms become more favorable. Lower interest rates, higher loan limits, longer repayment windows. But if the bank believes the business is owner dependent, the bank is going to protect itself. And the most common protection is the personal guarantee. A personal guarantee transfers the risk of failure back to the owner. If the business fails, the owner remains responsible. From the bank's perspective, this resolves the uncertainty. The bank no longer has to prove whether or not the structure works. It simply ensures that someone is going to absorb the loss. Think about an electrical circuit. A circuit breaker exists to stop dangerous electrical pressure from damaging the entire system. If the breaker works, the system survives the surge. If the breaker doesn't exist, the surge travels directly through the system. Structural insulation works the same way. If the business absorbs pressure independently, then the system holds. If the pressure travels directly to the owner, the circuit never existed. Banks observe this routing very carefully because lending money requires anticipating pressure before it actually arrives. If you're preparing to launch a business, this information gives you an advantage. Structure can be designed intentionally before exposure appears. Authority can be distributed. Financial stability can be built within the company itself. And if you're already operating a business, this episode becomes diagnostic. It helps you evaluate how institutions might interpret your current patterns. Because institutions rarely explain their conclusions. They simply adjust the terms. Banks aren't evaluating confidence. They're evaluating independence. They want to know whether the business can survive pressure without collapsing into the owner. If that independence appears clear, the lending becomes easier. If it doesn't, the bank quietly protects itself, often through personal guarantees, often through stricter loan terms, and often through declined credit. Understanding how banks evaluate structure reveals something many founders never see. The difference between a business that exists and a business that stands on its own. Imagine applying for business insurance tomorrow. The underwriter reviewing your file has never met you. They don't know your work ethic. They don't know how passionate you are about the business. They only see patterns. From those patterns, they have to answer one question. How likely is this business to produce a claim? We're going to explore how insurers actually evaluate your business structure. Not the theory, the process. We'll look at what information they examine, what patterns they interpret, and why some businesses that believed they were protected discovered during litigation that the structure never truly separated them from the company. Because insurance companies operate on probability. One way to understand underwriting is to think about weather forecasting. Meteorologists can't guarantee that a storm is going to happen. Temperature, air pressure, wind movement, these signals allow them to estimate probability. Insurance underwriting works the same way. Underwriters analyze patterns inside a business that historically produced claims. They're not evaluating whether you intend to run the business responsibly. They're evaluating whether the structure and behavior of the business suggests future risk. And they do that long before anything goes wrong. When an insurance company reviews a business, the underwriter is trying to answer three questions. How likely is this business to experience a loss? How severe could that loss be? And how predictable is the company's behavior? Those three questions determine the entire insurance decision. Coverage, premium, limits, exclusion, everything flows from the underwriter's risk classification. Every industry carries historical loss data. Restaurants, construction companies, transportation businesses, manufacturing, professional services even. Underwriters analyze decades of claims history across those industries. This creates a baseline risk score. For example, construction companies statistically produce more injury claims than consulting firms. So, a construction company begins with a higher baseline risk. But the industry alone doesn't determine the final classification. The underwriter then evaluates that specific business. Next, the underwriter examines how the business operates. They review ownership structure, management hierarchy, employee roles, operational procedures, because disorganized operational structures correlate with higher claim frequency. If authority is unclear, mistakes are more likely. If supervision is inconsistent, accidents increase. If the training is informal, liability exposure grows. Operational discipline reduces risk, while operational confusion increases it. Think about airline pilots. Commercial aviation is extremely complex environment, yet accidents are rare. Why? Because pilots follow strict operational procedures. Checklist, authority hierarchies, communication protocols. These systems reduce human error. Businesses work the same way. Clear operational systems reduces liability. Loose structures increase it. Underwriters evaluate these systems carefully. Insurance companies also evaluate financial signals, because financially unstable businesses produce more claims. Why? Financial stress increases operational shortcuts. Maintenance gets delayed. Training gets skipped. Safety procedures get ignored. Underwriters review financial statements to determine whether the company operates under constant pressure. Businesses that struggle financially tend to generate higher loss rates. So financial stability becomes part of the risk profile. At this point, it should start to feel familiar. Insurance companies aren't evaluating the business the same way that founders do. Founders focus on opportunity. Underwriters, they focus on probability. The founder asks, can this business succeed? The underwriter, on the other hand, asks, how likely is this business to produce a claim? Those are very different perspectives. Underwriters also analyze historical claims. Even minor incidents matter. Frequent small claims signal operational weaknesses. Not just bad luck, patterns. If a company repeatedly produces claims, insurers assume the underlying structure creates those outcomes. Past behavior predicts future losses. So claims history becomes one of the strongest indicators in the risk profile. Insurance companies also evaluate how businesses control risk. Safety policies, training programs, maintenance schedules, quality control procedures. Those systems demonstrate whether the company actively reduces risk. Businesses with strong internal controls receive better insurance terms because they demonstrate predictability. And predictability reduces uncertainty. Once the underwriter builds the risk profile, the insurance company responds in several ways. Higher premiums, lower coverage limits, specific exclusions, or additional requirements, or in extreme cases, denial of coverage. The insurer is not punishing the business, it's pricing the probability of loss. If you're launching a business, this episode reveals something important. Risk classification begins early, long before the first claim. Operational discipline matters from the beginning. And if you're already operating a business, well, this episode helps you understand how insurers interpret your company, because insurance companies rarely explain their conclusions. They simply adjust the premium. Insurance companies don't wait for problems. They evaluate the probability of problems. They analyze operational structure, financial behavior, claims history, risk controls. From those signals, they build a profile of the business, a profile that determines how the company is going to be insured. Understanding how underwriters think reveals something very powerful. Your business is constantly being evaluated by institutions, often quietly, often long before you realize it. And those evaluations shape the opportunities available to your company. Imagine a lawsuit filed against your business tomorrow. Customer dispute, contract conflict, or an injury claim. The business is named in the lawsuit, but the opposing attorney asks a different question. Should the owner be personally responsible too? That question changes everything. We'll look at what information courts examine, what patterns they interpret, and why some businesses that believe they were protected discovered during litigation that the structure never truly separated them from the company. Because once litigation begins, courts have to determine something fundamental: whether the business actually existed as an independent entity, or whether it functioned as an extension of the owner. And the answer to that question is rarely decided by the formation documents. It's decided by the behavior of the business over time. When a dispute reaches the court, the judge is trying to answer a simple but powerful question. Did the business operate independently from the owner? Or did the owner operate the business as an extension of themselves? This distinction determines who bears responsibility, the company or the individual. Courts call that analysis separation. But separation is not proven by the filing of documents. It's proven by operational behavior. The court begins with the formation documents, articles of organization, articles of incorporation, operating agreements, bylaws. These documents confirm that the entity exists, but existence alone doesn't prove independence. The court has to evaluate whether the entity functioned as a separate organization. So the analysis continues. Courts examine who actually made decisions inside the business, who signed contracts, who approved obligations, who directed operations. If every decision consistently came from one individual, the court may conclude that authority never left the owner. The entity existed legally, but operational authority remained centralized. And that pattern signals dependency. Think of the business entity like a uniform. When a player wears the uniform, they represent the team. But if the player ignores the team's structure and acts entirely on their own, the uniform doesn't change their behavior. It only changes the appearance. And courts are not interested in uniforms. They examine whether the team actually existed. Next, the court examines financial behavior. Did the business maintain its own financial identity? Did the company maintain separate accounts? Did the company maintain reserves? Or did the owner frequently move money between personal and business finances? These financial patterns reveal whether the business truly operated as a distinct and separate financial unit. If the owner regularly absorbed financial pressure personally, the court may interpret the business differently. At this point, many business owners recognize something uncomfortable because the court is not evaluating what the owner intended. It's evaluating what actually happened. And a business may operate for years believing it's separate, but if the operational patterns consistently point back to the owner, the court may interpret the structure differently. That interpretation only appears once pressure forces the question. Courts also examined what happened during the stressful moments, when the obligations became difficult, when the disputes occurred, when contracts became strained. Who resolved those situations? If the owner personally stepped in to stabilize every crisis, the court may conclude the business depended entirely on the owner. Again, this doesn't automatically invalidate the entity, but it does affect how responsibility is interpreted. Courts also review formal business practices, meeting records, corporate resolutions, operational policies, employee supervision. These documents reveal whether the company operated with internal structure. Businesses with documented governance appear more independent. Businesses operating informally appear more owner-driven. Imagine you build a bridge yourself. Not an engineer, just you, YouTube, and confidence. On a clear day, It looks solid. You drive your car across it, friends cross it, everything feels fine. So you tell yourself, the bridge works. But then one day, a fully loaded 18-wheeler hits the bridge during a storm. And halfway across, the structure starts to bend. Not because the storm created the weakness, not because the truck did anything unusual, but because the bridge was never designed for real weight in the first place. Your business is just a car, your day-to-day operations. That's light traffic. So everything feels like it's working. But the lawsuit, that 18-wheeler, a creditor, the sustained weight, a partner dispute, uneven pressure, personal liability, stress on the wrong joints. That's when the question shows up. Was this structure designed for pressure? Or was it just appearance? Nobody questions a bridge when the weather is good. But bridges don't fail in calm conditions. They fail under load. And business structures don't fail when things are going right. They fail when something goes wrong. If the court concludes the business functioned as an extension of the owner, responsibility may extend beyond the entity. The court may still exist, but the legal shield becomes weaker. This is why lawsuits often expand from the business to the individual behind it, because courts are trying to ensure responsibility reaches the correct party. If you're launching a business, this episode shows why operational structure matters from the beginning. Separation is not something you install later. It's something that must exist in the daily operation of the company. If you already operate a business, this episode becomes diagnostic. It helps you evaluate whether your company actually functions independently. Because courts rarely explain these interpretations in advance. They appear only when disputes force the question. Courts don't evaluate intentions. They evaluate patterns. Patterns of authority, patterns of financial behavior, patterns of responsibility. And from those patterns, the court determines whether the business operated independently from the owner. If it did, the structure holds. If it didn't, structure may extend or responsibility may extend further than expected. And understanding how courts evaluate structure reveals something many founders never realize. And that's that a real test of business structure is not formation. It's how the business behaves under pressure. Imagine sitting across a table from an investor reviewing your business. They're not asking about your passion. They're not asking about your work ethic. They're trying to answer one question. Who actually controls this company? Because investors don't fund businesses they can't understand. And control determines whether the company can survive growth, conflict, and financial pressure. We're going to look at the signals investors use to determine control, the documents they examine, and why many companies that appear successful still struggle to attract serious investment. Because investors aren't evaluating your enthusiasm, they're evaluating whether the company operates as a stable system. Who makes decisions? How those decisions are enforced? And what happens when disagreements appear? Those three questions define control. And control determines whether investors feel confident placing capital into the business. Think about a group text where 5 people are trying to make a decision. Everybody's talking. Nobody is deciding. Now, compare that to one person leading the plan. We're meeting here at 7. I already reserved it. Clear, simple, done. Businesses work the same way. During calm periods, unclear authority feels manageable, but under pressure, confusion about who's in control creates delays, conflict, and risk. And institutions don't tolerate confusion. They're looking for one thing: clear authority, because structure isn't about participation, it's about control when it matters. Shareholders, members, equity distribution, and at first glance, ownership appears to answer the control question. But investors know ownership doesn't always equal authority. Someone may own a large percentage of the company, yet have limited control over the operations. So investors continue their evaluation. Operating documents, corporate bylaws, shareholder agreements, board structures. These documents reveal how decisions are made. Who approves major transactions? Who appoints management? Who resolves disputes? Investors study these documents carefully because governance determines how power flows inside the organization. Next, investors evaluate decision authority. Who signs contracts? Who authorizes spending? Who directs employees? If decision authority consistently rests with one individual, investors recognize centralized control. And that's not necessarily negative, but it means the company's stability depends heavily on that individual. If authority is distributed through management structures and boards, the company appears more institutional. Institutional systems attract institutional capital. At this point, many founders recognize a common misunderstanding. Founders often focus on ownership percentages, but investors focus on decision structures. Ownership tells the investors who benefits from the success. Control tells investors whether the business can survive conflict. And investors care deeply about how the company behaves when things go wrong. They also examine how disagreements are resolved. What happens if partners disagree? What happens if a founder leaves? What happens if major decisions create conflict? Governance structures answers these questions. Clear resolution mechanisms reduce uncertainty. Ambiguity, on the other hand, increases risk, and investors avoid unnecessary risk. Think about a busy intersection with no traffic light. Cars move from every direction. It works until it doesn't. Now, add a traffic light. Clear signals, clear order, clear control. Businesses work the same way. When authority isn't clearly defined, decisions overlap and conflict. And under pressure, that confusion creates real risk. Investors aren't looking for activity. They're looking for structure that controls movement. Because coordination without authority is just delayed chaos. Does the company rely entirely on the founder, or does the business operate through systems and teams? Companies dependent on a single individual carry greater risk. If that individual leaves, the company may struggle. Businesses with distributed leadership appear more stable, and stability attracts investment. Once investors evaluate control structures, they adjust their investment terms. Clear governance structures create confidence. Unclear authority increases caution. Investors may require board seats, voting rights, protective provisions, or additional oversight. These mechanisms allow investors to influence decisions that affect their capital. From the investor's perspective, it's not interference, it's risk management. If you're launching a company, understanding control structures early provides a major advantage. Governance systems can be designed intentionally. Authority can be defined clearly. Conflict resolution can be established before disagreements appear. And if you're already operating a company, this episode becomes diagnostic. It helps you see how investors might interpret your current structure. Because investors rarely explain their concerns directly. They simply adjust the deal. Adjusters don't evaluate passion, they evaluate control. They want to know who makes decisions and how those decisions are enforced and how authority survives conflict. Ownership reveals who benefits from the success. Control reveals who guides the company through uncertainty. And understanding how investors evaluate control reveals something many founders never realize. And that's the businesses that attract capital are not just profitable, they're predictable. Because investors are not just funding opportunity. They're funding systems they believe will hold under pressure. Imagine applying for a business loan tomorrow. The bank reviews your application and says the loan is approved. But there's one condition. They require a personal guarantee. At that moment, many founders ask the same question. If the business exists, why does the bank still want me personally responsible? That question reveals something important. Because a personal guarantee is not just a contract term. It's a signal about how the bank sees your structure. And we'll examine how lenders interpret structural independence and why some businesses receive loans without guarantees while others don't. Because personal guarantees are not random. They appear when the lender believes the business may still depend on the owner. If the business can't repay the loan, who ultimately absorbs the loss? The company or the individual behind it? If the lender believes the company itself can absorb that pressure, the loan may stand on its own. If the lender believes the company still depends on the owner, the bank transfers the risk back to that owner. And that transfer happens through personal guarantee. And if authority, financial stability, and decision making appear concentrated in one individual, the bank recognizes a dependency pattern. The entity exists, but the business appears to rely heavily on the owner. That increases uncertainty. Think about renting an apartment. You walk in, confident, but the landlord says, "We still need a cosigner." Why? Not as a penalty, not because your story is bad, because if something goes wrong, they want someone else on the hook. That cosigner is the backup plan. If you don't pay, they will. That's exactly what a personal guarantee is. The business applies for the loan, but the bank is thinking, what happens if this structure doesn't hold? So they add you, not as a partner, not as a helper, as the fallback. If the business fails, you pay. The bank isn't evaluating confidence, they're evaluating exposure. And when they see new entities, thin operating history, unproven structure, they don't reject you. They pull you back into the deal because your structure didn't fully carry the risk on its own. Banks also examine financial behavior. Does the business generate stable revenue? Does it maintain reserves? Or does the owner regularly inject personal funds into the operations? If the owner repeatedly stabilizes the business financially, the bank recognizes that the business may not yet sustain itself independently. And that pattern increases the likelihood of a personal guarantee requirement. Another signal comes from credit history. Businesses with established commercial credit profiles demonstrate financial independence. Businesses with little credit history may rely more heavily on the owner's personal credit. When the lender sees this dependency, it may require the owner to guarantee the obligation. At this point, many entrepreneurs recognize something important. The personal guarantee is not a punishment, it's a transfer. Risk that should stay in the business gets transferred to you. It's a response to the uncertainty. The lender isn't trying to prove that the structure fails. The lender is protecting itself in case it does. And that protection shifts risk from the business back to the individual. Personal guarantees transfer responsibility in a very specific way. If the business defaults on the loan, the lender can pursue the guarantor personally for repayment. From the bank's perspective, this resolves the risk question. If the business succeeds, the loan is repaid normally. But if the business fails, the guarantee ensures the lender still has recourse. Think about standing in the rain with a small umbrella. From a distance, it looks like you're covered. You've got protection. You have structure. But then the rain gets heavier. The wind shifts. Water starts hitting your shoulders. Then your back. Then everything. The umbrella didn't fail completely. It just didn't cover enough. So what happens? You get wet. The business structure is the umbrella. It's supposed to take the hit, contain the exposure, keep things separate. But when the structure isn't strong enough, the bank doesn't pretend you're covered. They step in and say, we still need you under this. That's the personal guarantee. And what it really means is that the pressure didn't disappear. It just reached past the structure. It's now touching you. And if you're launching a business, understanding guarantees early helps you recognize how institutions evaluate structural independence. As businesses mature and demonstrate stability, lenders may become more comfortable reducing personal guarantees. And if you're already operating a company, guarantees can serve as diagnostic signals. They reveal how lenders currently classify your business. Because institutions rarely explain their reason directly, they simply adjust the terms. Personal guarantees reveal something many founders never realize. Institutions evaluate businesses differently than entrepreneurs do. Founders focus on opportunity. Institutions focus on responsibility. And when lenders require personal guarantee, they're revealing their interpretation of the structure. They're signaling that the business alone may not yet absorb the risk. Understanding that signal helps founders see their company the way institutions see it. Because the real test of business structure is not formation. It's where responsibility ultimately lands when the pressure appears. If this gave you a different way to think about your structure, then like the video and subscribe, because most of what's out there is focused on formation, not what actually holds under review. And if you're already operating a business, then there's a free resource in the description called the Structural Exposure Check. It's a simple way to see whether your business is actually separate or just documented that way. And remember, structure isn't what you file. It's what survives under pressure.